Welcome, everyone, to the Talk With Kiet show, where we connect people, capital, and ideas to help make a difference. I am now live with Andrew Eisen, the CEO, and Blair Silverberg, the founder and president of Hum Capital. Andrew, Blair, and I will talk about their extensive career and entrepreneurial journey, as well as discuss the future of AI in lending. Now, today is special, it's different because it's the first time when we have the founder and former CEO transition to a new CEO of a company he's founded and entrusting now with a new CEO in place. Before we talk about how they start with that journey, we usually start to talk about the origin story. So Blair, Andrew, welcome to the show. Let's start with your origin story. And Blair, I want to start with you. What is Blair's origin story?
Awesome. No, thanks for having us. Happy to take that one. So I grew up in Austin, Texas. I started to invest in public markets when I was 12. When I was 7, actually, I got some Beanie Babies for Hanukkah. Realized in the early days of eBay they could be sold on the internet for more than my $0 cost of goods. And my mom helped me sell some Beanie Babies I got from my grandmother on the internet. I accumulated some capital by doing that. I couldn't really do anything with it. My parents wouldn't let me spend it on toys or anything fun. By the time I was 12 and I had a bar mitzvah coming up, I was basically sitting looking at this capital sitting in my Ameritrade account. And my parents had been telling me for years I should get into the stock market investing. And so I just got really into investing around the age of 12 and read pretty much everything I could get my hands on, like every Warren Buffett book, biography I could find, all the Berkshire shareholder letters, Buffett Partnership, John Burr Williams, Philip Fisher, just tons and tons of stuff, like books from the 30s. Really got into it. I felt like it was a way to learn about how the world works by learning business by business, how businesses work. And basically, when I graduated college, became a venture capitalist, transitioned to private markets, loved the concept of private markets because in theory, they are very opaque. Discovered that the workflow of looking for companies one coffee meeting at a time is like how the public markets worked in the 50s. It's just so out of touch with how the efficiency in public markets today makes searching for investments through things like stock screeners and pricing investments with strategies that quants write instead of humans like guess. Just so different, such a big difference between publics and privates, that I got 5 years into my venture career. And as much as I loved the space, I really couldn't imagine building a career as a venture investor without having a set of systematic tools that would give me an advantage. And so I left venture. I started Hum. I was fortunately seated by two of my old bosses, Steve Jurvetson and Tim Draper, to get the business going. And basically have, over the last 5.5, 6 years, built the software toolkit that I dreamed of having to navigate privates as an investor. And at the same time, there's a company-facing element of the story, which I'll really briefly summarize here. But we, in addition to helping investors find companies much more efficiently, which is kind of like the tool I built for myself, we also tell companies everything investors know about understanding them and pricing them and the kind of feedback they wish they could get, but no private market investor has time to give it thoughtfully. So there's a two-sided market that we've been able to create with software at the center.
Awesome. And then Andrew, a bit about your origin story and how do you come about from being a senior partner at a publicly traded company to now joining Hum?
Again, thanks for having us today, Kit. I'll do a similar origin story from the other side of my childhood. Growing up, I had the messiest handwriting out of any kid you'd ever meet. And somewhere between 3rd and 4th grade, I had to learn how to use a typewriter and a word processor to type my homework up so my teachers wouldn't fail me. And that became my first introduction to using technology to help with workflows. And since that point of my personal life, I just continued to develop technical skills and get comfortable with technology. I grew up in Toronto, went to the University of Western Ontario and business school at the Ivy School of Business. And it became clearer and clearer through those years how important technology was in business. And then from school, I started off in it at Accenture doing consulting on human performance management, but often relied on technology and investing in technology to get the most out of our people. I then went to a startup called Jana Systems, which was a CRM provider for institutional sales and research, insurance, and capital markets, where we designed systems that helped salespeople and the banks and asset managers understand their customer behavior and then ultimately cross-sell and optimize the value of those customer relationships. We were acquired in the dot-com boom by Siebel Systems, was one of the largest exits of Canadian companies. I believe our valuation worked out to be around $1 billion. And from there, moved to New York, worked with Siebel, did a handful of West Coast startups after the dot-com, trying to find that success and that excitement that comes with building something great. Worked in equity research, helped start a small boutique equity research firm, and later became a small broker dealer. And then about 15, 16 years ago, where we met, Kit, went to a small private company called Market Partners, where they use technology and data to understand and value derivatives, opaque markets, credit default swaps. And over the 15 years there, I had a number of roles that I remember sitting across the desk from you from, but in the last hurrah, I was running a software solutions business unit for what was IHS Markit and now S&P Global, where we were a portfolio of 6 or 7 software businesses that were built or acquired over the last 15 years, servicing capital markets, private credit, broadly syndicated loans in the front and middle office, all helping institutions run their books better. And as part of that, I was responsible for helping craft and execute our strategy collectively for private markets. And I had stumbled on this startup called Hum Capital that was using our AI and other advanced technology to understand the businesses and the small companies in this direct lending private credit space. And there was an immediate appreciation for what Blair and the team had built to be able to apply that to the rest of the market, whether it be private equity, private credit, real estate, infrastructure. There's just a number of segments of this market that are underserved by technology, and I found that very exciting. With the recent changes of leadership at S&P, I decided to retire and take some time off, recharge, and spend time with my wife and 3 young daughters. And the day after I retired, Blair called up my wife and my children and started a campaign to lobby me to come work with him. I relented because my wife wanted me out of the house. And lo and behold, about 6 weeks ago, I started working with Blair as CEO of Hum Capital. And that's Blair, the short origin story.
What was going through your mind? That must be crazy to say, Andrew, come here and take over CEO role for this thing I founded, like this baby of mine. Like, what's going through your mind in terms of?
So it was interesting, Kit. I mean, the first part of it was I was incredibly appreciative of the technology and the vision that Blair had, which was why we led the investment of S&P strategically into Hum Capital. So I had this, I would call it an appreciation or respect for the capabilities and the technology that Blair built. The other piece that went through my mind is this is something that is the next generation of technology. Having lived through the transition to the web, having led the transition to the cloud, AI in capital markets and private and in investing is the next generation. Whether we admit it or not, 5, 10, 15 years from now, everybody in this industry is going to be using these types of tools. So why not get on the front end of the curve? And interestingly, the third piece, which is I have to say I'm least proud of, there was a part of my mind that said, how could I go from managing nearly 2,000 people and $500 million in revenue to a small startup of 30 people where nobody knows who I am or who cares? And it was really a piece of it was like putting your ego in check and just getting excited about working with some great people and some great technology and an opportunity to be on the leading edge of another transformation in the market.
And Blair, how about you from your perspective?
I mean, like I had gotten to know Andrew with him as an investor in Hum, and it, as a founder, you're every once in a while you stumble across people who share your vision and have arrived at it on their own, but usually it's a piece of the vision. So years talking with people and synthesizing information and thinking about what you hope you can build over a 10, 20, 30-year period of time. And Andrew's the only person I've ever met where we sat down for about a 5-hour dinner, the first time we ever met in person. And he just told me my vision, word for word, every single detail. I'm sure he felt like I was telling him his vision, word for word, every single detail. There was just such alignment around what we thought needed to be built that I was lucky to get him as an investor. I never, in my wildest dreams, imagined I could convince him to come work at the company full time. So when I saw an opportunity to do that, which to his point required lobbying the entire family and trying to get really creative about how you get a guy to, like he said, move from a 2,000 person division to a 30-person startup, I sprinted toward it, because as a founder, you just want the best people working with you. You want to have fun. There's more work than any one person can do. There's no room for egos at all. I mean, I never thought for a second about handing over the CEO title as a negative. I was just like, I can't believe that I have a shot to get this guy to join the team. And we work incredibly well together. So we're calling each other like 5 times a day, talking through problems. I mean, he's a real thought partner. There's just so much to do as a startup that you just really can't waste time thinking about ego. You have to just spend all your time focused on how do I make this thing that's in my mind a reality.
Yeah, and before we dig deep in that, because I do see the camaraderie as we have these prep calls, right, which is amazing. I want to talk about, you go from being a VC where you write people checks to then you launching a company asking people to give you money.
Yeah.
Talk about that, mental transition a little bit.
Meaning, like, how did we raise money in the beginning?
Yeah.
For Hum?
Yeah.
So I'll try to give you a medium-sized answer on this, because I can monologue on this for a long time. So VCs have a lot of advantages in starting companies because you see what gets funded, a bunch of investors, some very well because you've sat on boards with them. So there's a lot of advantages. On the flip side, you're very selective about what you would even be willing to start. Like, the last thing most VCs want to do is start a company, because you see so much failure. The number of smart people, like PhDs with a contrarian vision, with $20 million from their best friend's family office, who fail, is just mind-boggling. So what ends up happening is your bar ends up being very high. And for me, at least, that meant that I was only willing to start something if it was incredibly contrarian. And things that are contrarian are almost impossible to get funded. FedEx got turned down from Bessemer but 20 times. 20, I can't even imagine 20 times from the same firm. Love to know if that story is actually true. I think it's on their website, and I've heard it many times, but it sounds kind of crazy. But Intuit ran out of money 3 or 4 times. So some of the biggest companies have the hardest time raising money, and we've been very lucky. It's never been easy, but we've been very lucky to raise the capital that we have. But I think the shift to asking for money, I thought it was going to be easy. It was incredibly difficult. And really, if you think about our business, we're kind of explaining to investors who we were asking for capital from, that the way that investors in privates, which is what they do, the way that they operate is going to change. And so it's just a big learning curve, and a lot of, I think, confronting how the future is going to impact their own business that they didn't have to do in other lines of business. Because if you talk about a new AI focused database, that's somebody else's business. And thinking about how to fund that and how to build a great business around it feels very natural. When you say, hey, the job of the venture capitalist might dramatically change in a world where large language models can analyze a lot of information you're looking at. But that's okay. Get behind this. There's only so many firms who wanted to hear that. And we were very lucky with Steve Jurvetson and Tim Draper, for example, that they're very future kind of optimistic about the future. And so they didn't feel any attachment to, hey, my job may change. They're also just very self-confident in the success that they've had. But you can imagine a mid-level person at a venture firm hearing that their job is going to dramatically change. That may not be a fun thing to hear from a company telling you they plan to disrupt things.
Yeah, yeah. No, it's always difficult, but I would imagine also it's always difficult where the mentality shift, right? Where you're writing people checks and now you're asking people for checks.
I mean, you have to do whatever it takes as a founder. So you just got to get over that. It is not fun to go from being, I was just telling Andrew this yesterday, that like people were so much nicer to me when I had the checkbook. I didn't realize it's like, oh, I'm like a lot uglier than I guess I thought I was. Like, I'm just, the world did shift, but as a founder, you just have to put your head down and do whatever you have to do. So it's not fun to flip from the person who is in demand to the person placing demands and doing the sales job. But at the same time, you can't be a founder without getting comfortable asking for checks.
Yeah.
And Kit, if you think about it, it's the difference between buying and selling. Once you make that transition from giving people money to trying to explain your story, you're switching to sales mode, and the best salespeople, the best storytellers at the end of it know how to ask for money. And it's a skill you develop, and that's just it was interesting because Blair and I kicked off a small friends and family round upon my joining to try and integrate our two networks of investors and relationships to accelerate the success of Hum. And I had never raised money before, which was one of the first questions I asked on the first day at work. Is like, okay, how do we do this? And Blair said, well, we'll have some meetings with existing investors and we'll reach out to some people, and you'll ride shotgun with me, and we'll iterate through this. And by the second week, it just slipped into the pattern, like everything we've ever done on the other side, selling. And you're selling the story, you're explaining the value of what you have, the value proposition. And we've in software, you're often educating customers and markets about how trends are changing and how to be on the leading foot and how to take advantage of new technology and new capabilities so you get an edge in business. And it's remarkably similar, if not identical, to fundraising. Because you're ultimately explaining the same value and the same story, except instead of here's my technology, will you use it? It's will you invest in our business and the management team to create economic value for you and your funds or your partners.
No, and look, you guys saw me within the first 15 minutes, right? So job well done on that. Now, look. If you think about alternative assets, right, it's like a $22 trillion asset class, and it's growing, especially around private credit. But the tooling involved and the landscape changing, it's ever evolving, right? You look at like the last 10 years, everyone's like transitioning to the cloud. And I said, forget cloud, let's figure out how to adopt AI. And it was funny, I was talking to portfolio manager. He managed $10 billion. He's like, Kit, my life revolves around Excel and Word, all these fancy tools, like we don't get to use. Like how do you transition into the workflow of these like larger asset management firms that's actually living in the Stone Age?
Andrew, do you want to take that, or you want me to take it?
We can do it together. I think the first part from a technical side, Kit, is you never leave Excel because it's what everybody today is used to. So it's about giving a path to a technology that most people don't understand or don't know how to utilize, and give them tools and a framework to work in that they're comfortable with. I mean, the biggest challenge with new technology paradigms, and having lived through the cloud, the transition to the web, and now AI, you're in a market education, a user education, and a change management exercise. So when you're talking to the portfolio managers who are managing hundreds of millions, billions of dollars, their entire experience is in these traditional sets of tools. And as new generations of analysts come through the system, they're like, why are we in the dark ages? And you get this generational gap, and we've seen it across over the years, between the new entrants who are whatever generation, more technology savvy, and the old generation who has all the pocketbooks and all the capital and all the experience who are still doing things on paper. So that pattern repeats itself every 10 or 15 years. And once you're familiar with that pattern, you understand how to limit the friction or help make that transition. So you have to articulate, one, the value of the technology in dollars and cents and performance and time saved. And two, you have to think about the humans and how they transition their behavior and give them a series of small steps or milestones for them to go from doing everything in Excel and in paper to technology. And so what you find is everybody understands the idea of what AI can do, and they get really excited when they see the tools. And then we literally have seen this, and I won't share names, but he's probably watching this podcast, where they take all of the data out of the system in the AI, drop it into Excel, only to present it back to humans from Excel and from PowerPoint, because that's what they're most familiar with. And you know that behavior is just normal, and you just kind of keep iterating on it. So it is kind of funny that it's just a repeat of that pattern again. And now we're, I'm a little bit older than perhaps Blair is, so I'm on the other side of it, where I'm the guy used to Excel and PowerPoint, and he's the guy who's whipped up stuff in Python, like the charts you see behind him, that do fantastic analysis that used to take humans weeks. Did I miss anything, Blair?
Yeah, the only other thing I'd add is, like, there is a strategy element to getting the customers comfortable. So in private credit today, there's more capital than there are deals to be done. And so people need deal flow. And so we're generally today, and that may change a bit in the future, but generally today, we're not selling software to people as the way in. We show people deals. We've been able to successfully aggregate a lot of companies, the many thousands of private companies, onto Hum, because they come to us asking us what terms the market's going to give them. And we tell them in a very specific, personalized way using our software, hey, you can probably get $4.2 million of additional capital in the form of debt. It can come in these two different flavors. Here's what the cost is going to be. And no one else is helping these companies understand at a granular level of detail based off of their performance, what their capital structure should look like. So that aggregates companies. And then in turn, when these companies want to raise capital, often we're reaching out to the investor community and we're saying, hey, we've got a great new business that you should take a look at. And so that's how investors get introduced to our software. They see a deal, they don't see software, but to see the deal, they have to use our software. So that builds familiarity. And it's been a core part of our strategy from day one that we're not trying to convince people to change their behavior. We're showing them what they want. We're just also showing it in a format where they have a bit of a better way, better experience. And when they go through that experience and they start asking themselves questions like, why don't I see all of my deals with standardized data like I would in public markets? Hey, why can't I see like cohort analysis on every deal I look at? Hey, why do I have 37 companies in my portfolio and I can't tell my LPs what yesterday's revenue was on any of them? Like, why does the world work that way for investors? It just doesn't make any sense. But we show versus telling.
Yeah, talk a bit about that chart behind you, because that's an interesting chart.
So this is we have like hundreds of these. This is one of my favorites. So this is a cohort retention chart. So as an investor, when you make an investment in a company that is revenue based, so think like every corporate investment, not real estate, not like construction, but like every corporate investment, every operating company, whatever it is, $200 trillion probably of outstandings and bonds and equity, these kinds of investments. What you really want to know is revenue sticky? Is it going to grow on its own? What happens if you turn off the sales and marketing spigot? You want to understand revenue quality. Those basic questions that any investor would have. Now, unfortunately, when you're looking at the income statement, you can't understand revenue quality. Just doesn't have sufficient detail. Like, there's no detail on the underlying customers. Are they churning? Are they retaining? Do they take a pause in their payments and then they come back? You just don't have any of that detail. But fortunately for us, the payment processing systems do. The accounting systems often do. The online banking systems certainly do, because revenue comes into a bank account somewhere. So we're able to analyze this data into monthly, quarterly, daily, weekly, any frequency we want, cohort analysis, and actually see retention. So I think this chart probably, it's a little hard for me to see in the background, but this is basically a business where 10 months into the life of the average customer, 80% churn, 20% stay. But then from there, the business is pretty sticky. So that's like very useful information you'd want to know as an investor. And it's kind of crazy to me that there's, whatever you said, $22 trillion of alternative assets where most people don't know this information.
Yeah. So is this one of the many secret sauce? Because your portfolio return, I think, is averaging like 22%. Like that's just insane for me to just imagine and think about consistently. Like what's driving that? What's the secret sauce?
Yeah, I mean, so one of the things we do in the business is we really admire BlackRock and the way that they've built their business, where they have a thriving software business called Aladdin, and then they have an asset management business that uses their software. So we have a very similar model internally for privates. And so we have this great software. We use it to manage money. One of the strategies we manage does have a great return, kind of low 20s, loss rate sub 1% per year. Just really an unusual profile, all cash yielding, by the way, like monthly cash flows to the investors in this thing. A very unusual profile within private credit. I can go into details later if you want on like how exactly we do this. But one of the key things we do is we take the companies that are connected to Hum and we're able to see this level of information on them. And so selecting investments, offering terms to companies, you can imagine we just have a lot of advantages when it comes to picking credits and monitoring credits that come from monitoring daily data like this. So yeah, you're right.
And I think, Kit, there's still a human factor involved in that process, in that investment management process. And our thesis is when you take really powerful technology and you give it to really good people, you create extra alpha, right? So if you go back to our starting point where how Blair and I got along and we were in a common vision and an appreciation of the strategy, he said early in the process, he surrounded himself with really good people. So by being selective of what people you bring into the business and then giving them really powerful tools, you can create not just operational alpha and lower the cost of doing the deals, but you can use that experience and those capabilities of those exceptional humans to drive outsized returns. And it's really that combination that's unique. And so, I do want to shout out, it's the technology and the business and the people. And that's what you'd want, right? You always want that human in the loop, because a lot of history has taught us that purely machine-driven investment management can miss, with bias and details, can miss significant risk. And so you really want that human in the loop to help balance out and check the machine. And I think that mix is what makes it unique.
Now, do you foresee a day where there's no need for human in the loop, or you think there'll always be a need for human in the loop?
I mean, Steve Jervis and I used to invest in AI together, and you never say that you'll always need something because you just don't know how the technology will ultimately evolve. But I think there's physical systems and there's adaptive systems. The markets are an adaptive system. So ultimately, humans are trying to guess what other humans are going to do. And in systems like that, it's very useful to have a human in the loop. You don't need a human in the loop to model how a 747 works. That's a fully automatable problem. But the markets are going to be the last thing, I think, to be fully automated if possible.
And the other side of it is, right now, humans like to do business with other humans. And they like to use technology and machines to simplify and reduce friction of doing business. But there's a human component to everything because we're social animals. And the power of our lizard brains and that social animal is, you have to appreciate it, and you have to build a business model that accepts that. Because ultimately, if you want a trusted relationship and you're putting your life savings or hundreds of millions of dollars to work, somebody somewhere wants to know, who do you call when you have a question? And when something goes wrong, where does that person live so I can drive over to their house, knock on their door, and interrogate them further, right? So there is as much of a purist would like to say everything could be automated and machine driven, as humans, we still need that social interaction and that trust to be built with other humans.
Okay,
at least for now.
No, so that's very insightful. Now, for the tough question. So Blair, before Andrew, you had all the ultimate chief deciding officer. Now we're like, how do you guys make decisions?
How do we make decisions now?
Yeah.
I mean, so there are easy decisions and hard decisions. For easy decisions, we've divided up the organization in a way where everybody reports into Andrew, basically. And so I can help Andrew with things. I have my own role kind of within the organization, focused on the investment business. So easy decisions can get made kind of by the organization at different levels. Hard decisions, we basically call each other and just talk it through. And it's such a lonely job being the founder or the CEO. If you're lucky enough to create a dynamic where you can sound ideas off of each other. And I mean, many of the best businesses have had this. Sometimes people have been very open about it, like Eric Schmidt in the early days of Google, or Sheryl Sandberg at Facebook. Other times, you think Jensen Huang doesn't have some amazing people on his team that he's sounding ideas off of, like he certainly does. So sometimes it's a little bit less public who these people are and what the dynamic is, et cetera. I think for me and Andrew, like we can just sound ideas off each other. And sometimes I'm trying to figure something out and I need his help on. Sometimes it's the opposite. But it's building a great business. There's just too much to do to have an ego.
And I think, Kit, you have to, and everyone watching, you have to appreciate how unique Blair's perspective is as a humble founder and former CEO. Very few people who are successful feel comfortable saying they don't know, or I need help, or partner with me on this. And past experience, there was a time where I thought I had to know everything in the room. And the reason why I was in a leadership position was because everybody assumed I had all the answers. And then you learn two things. One, you're wrong as much as you're right, if not more. So you have, the collective wisdom of your team is particularly important, especially because you can't know everything about the entire business. And two, you know how lonely it is the closer you are to the top. And so when you have a dynamic where we got along before we did business together, we have a different set of skills when it comes to management and investment and blocking and tackling and technical skills, with different set of experiences. When we do come to those really tough questions, and we've had a number of them in the last 6 weeks, it's usually, okay, what is your experience set tell you? How are you phrasing the question? How are you phrasing the problem? And the other side, whoever it is, will say, well, this is what I heard, or this is what I think, and this is what my experience set says. And let's at least agree on a common description of the problem. And once we've got a common and agreed upon description of the problem, what happens is the solutioning becomes very easy, because we're not talking at each other. We're not talking around the problem. We're not just talking about what's important to us. We reached an agreement or a common definition of the problem statement. And that has been the secret so far is, okay, what's the real problem? And often Blair, who is far more technical than I am and has, smart guy with a really cool stuff he learned in Stanford, I have to take 30 minutes to ask him really basic questions to distill the problem statement into something that I can understand. And what's really funny is through that exercise, I'll just say, so why don't we do this? And he'll be like, that's a great idea. And I'm like, well, it took me 30 minutes of trying to understand what you were saying before I was able to ask the one right question. And that's the dynamic, and it's been great.
Yeah, look, I can see the camaraderie. It's very unique. I do say, because to Andrew's point, Blair, and I don't think you appreciate this, but a lot of founders I've seen are very high ego, and they're the last to admit that they need help or they need to find the right partner, right? And in a way, it's like giving up my empire, right? People like to empire build, but I can see from your perspective, it's really about a coalition of the willing and working together to really create something big and interesting, which is In a way, that's the dynamic we grew up in, right? Andrew, at IHS Market, it was really about, look, none of us have all the answers. And as a collective, we will have the answer, right, from that perspective.
I guess there's different reasons why people start companies or projects or do their work. And I think for Hum, we just believe that the world needs to have a more efficient private market. And we think if we deliver that, then capital will be allocated better. And when capital is allocated better, we know from the Industrial Revolution that society gets richer, diseases get cured, just the world gets better. And so there's nothing in that mission statement that's about a person having an empire. It's about delivering something for the world that makes a difference. And so there's just in our business no place for people having their own agenda, really. And not all businesses are that way. I think some people build businesses because they want to create and attach their name to something, or they want a certain level of approval. And no judgment. One of the beautiful things about building a business is you can create whatever vision you want, and as long as you execute, deliver on it, and it really is a creative canvas that's amazing. But in our business, there just isn't and never has been room for agendas other than make the mission happen, and that's just so much to do. It just keeps people very occupied. And I don't really know. I wish I had more empathy for people who would have a hard time like bringing in a CEO, because I just don't understand it. I can only see building a business this way. You have such finite time. It's like, why not do something really big? And doing something big is so hard. You need all the good hands on deck you can get. But yeah, it's a key part to our culture.
I think if you look at the core mission of what Blair and the team, and there are a number of founders with Blair that did this, and I almost feel like we should call them out. But when you look at the foundation, it's the premise of bringing transparency to the companies that need capital, right? So having shifted from a fairly large public company and formerly large private company and startups in my past, efficient capital is such an important component of business success. And if you think about our society and capitalism, the more successful and the more efficient and the more targeted capital that goes to the companies means those companies can achieve their growth, they can grow their jobs, they can provide benefits to the people. Like, if you really believe in capitalism, you're investing in the structure of wealth creation and society, benefit for society. And that was the original premise of Hum, was to bring transparency to the companies that need capital so that they can get the most cost efficient capital in the most efficient way. And there's always a time to value, right? There's a immediate gratification you'll pay a premium for because you want to go back to running your business, or there's a competitive auction where you get the lowest cost of capital, but your opportunity cost is time and effort. And if you think about a business that was founded with the intent of reducing friction for companies who need capital to get it, and then providing the transparency to the providers of capital, whether it's our balance sheet or other investors, so you can match those needs of the companies to your mandates to give capital, you're reducing friction in what is capitalism and creating value for everybody. And that value just multiplies. So it becomes easier and easier to say, hey, by doing this and helping everybody, it just creates more benefit. And the people who lose are the ones who don't embrace that transparency in those tools and want to hold on to their kingdoms the way they always ran. And again, it's just another generational thing of, I'm sure 10 years from now, someone will point to me and say, I don't get it. I'm an old guy. And I remember the days when cars had gas, and that will be the generational change.
Andrew, you're ready though, so it's okay.
Yeah, I am feeling it today.
Well, this is interesting, right? Because in the last show, we had Mac Thompson on. Mac Thompson is CEO and founder of Whiteley, and they offer a lot of solutions for regional community banks. And we're seeing the structural dynamic change of banks, right? And when in the old days, when you run a small business, and look, more than 50% of employees are employed by small, medium-sized businesses. And now you can't go to your local corner bank to say, I need a loan and a relationship, because that's changing. The balance sheet structure, there's less and less retail stores you can go to. And what's happening is a lot of that's flowing to the shadow banking space, the private markets, hence that's growing tremendously. But the issue you raise, Andrew, is, well, how do you find those capital? How do you connect the people that need the capital to the right capital? And how do you minimize that friction, right? And it's interesting what you guys are doing. You're essentially minimizing that friction and actually creating transparency where people that need capital can now show their ability to take on that capital, because you're creating now easier way to assess and validate their revenue and their business model, and connecting that to people that have capital. That's like a powerful proposition, because that's the engine that the American economy needs, right, from that perspective.
100%. And it's a two-sided. I couldn't have said it better either. It's a two-sided problem. I spent a couple hours this morning with the family office that we work with, and they were talking about how crazy it is that across their portfolio, it's so hard to access data on companies. They've provided the capital, they've taken the risk, the companies appreciate the capital, but nobody has time to deliver daily updates to the investor. That has to be solved by technology. And then conversely, you talk to companies, walk two steps outside and you'll bump into a company that's had a bad experience raising capital. Every company's had a bad experience raising capital. We've had bad experiences raising capital, whether it's, hey, the investor didn't give me any feedback, I wish I knew what they were thinking, to the decision-making process seems arbitrary, to I ran a whole investment process, I put a ton of time into it, and then I just randomly realized there were 5 investors I should have known and talked to in the process. I mean, it's not an efficient system. And so it's kind of amazing to look at how much we've created wealth in our society with the capital allocation system that we currently have. It's obvious it can be made much, much better.
In fact, we were having a conversation with some potential investors last week, and they were doing a fundamental analysis of our business and our portfolio. And this goes back to the importance of a human in a loop. Because we said, hey, as a function of understanding the business and the people and the portfolio, why don't we go out for a drink, get to know each other, and make sure we have a social aspect to the relationship. And somewhere into the first or second tequila, true story.
But we're not sure where.
We're not sure which part of the tequila. True story. Blair turns to one of the investors, and I'm not going to share their name, and it says, what are you thinking about this particular aspect of the portfolio? And the investor says, well, we were saying, we phrased it this way. I spent the last 2 weeks building this model this way, and I've done all this analysis. And Blair looks at him and goes, but why would you do that? That doesn't make sense for what we do. And if we had not had the drink, or they had access to our platform, that 2 weeks that poor, I'll call him investor, and his team pulled together all of this analysis, which had to be thrown out and redone this week, you realize that despite the amount of capital that's being deployed, the processes are still incredibly flawed. And that's just, it's every conversation we've had with investors or companies, it seems more and more apparent that the marketplace is ripe for modernization. And this network, and you've seen this and I'm sure Blair has lots of history books on the history of capitalism, where the symmetry of information and matching buyers and sellers coming together to create a network effect. It seems like this particular segment of capital markets is still disconnected, and widely so. And so it's very clear that a connection or a hub and spoke model or a marketplace is particularly relevant, where there are some consistent standards on sharing information and providing color between the buyers and the sellers, or in this case, the capital and the people who need it.
Awesome. Andrew, Blair, it's amazing to have you on today. Thank you for your time. This is so insightful. I'm getting all these pings from people on how great this is. I think Ray Cherney, who's a senior exec at Broadway, was like, Blair is the exception as far as founder go. So kudos to you. Now, usually when we end the show is a question for you in terms of, who do you want to connect with and how can the audience help you?
Oh, we want to connect with investors that think there's a better way.
And we'd like to come to the small and medium businesses that need capital and want to be connected to those investors who think there's a better way.
Fantastic. Thank you, Andrew. Thank you, Blair. Thank you, everyone, for your continued support. Have a great weekend, and we'll talk to you next week.
Thanks for having us.
Thank you.